My guest today is Professor Mariassunta Giannetti, who's Professor of Finance at the Stockholm School of Economics. She's a research fellow at the CEPR and the European Academic Director of the Financial Management Association. Welcome, Mariassunta.
Thank you for having me.
Yeah, thanks for doing this during your vacation all the way from Italy. So we have a number of papers that you published recently between 2019 and 2021. And we have sort of two buckets of papers, one in the area of corporate governance and ESG, and other in monetary policy. So I thought I would start with your 2019 paper, which sort of put things in context. And it's entitled, Does Money Talk? Market Discipline Through Selloffs and Boycotts. You say, you ask, can market discipline affect corporate environment and social policies, E and S policies? You say using international data on negative news coverage of corporate E&S risks, we show that E&S conscious investors divest firms with heightened E&S risk. So before we get to the details of this, how do you define E&S risk and how do you measure that?
So, there has been a lot of interest recently about corporate sustainability, and there has been many new companies that basically provide information about the news coverage, about the incidents of regarding corporate, environmental, and social policies. So we use data from one of these companies. And these data have been collected, of course, if there is a news coverage of incidents like the BP spill on Financial Times, Wall Street Journal, that is in the data. But the company also collects information from a local newspaper. For instance, if some company is destroying the environment with polluting and so on, and even from blogs and websites of NGOs. So basically, we have new counts of news on different topics that are related to a company's social policy, a company environmental policies, and these are classified depending on whether these incidents are severe or are something that is just a minor violation of regulations and standards.
Okay, so a lot of information is collected in terms of corporate actions, incidents, policies, and this company essentially aggregate all that information, drive that to some sort of a metric, right? They call E&S risk. And what you're finding here is that risk score essentially affect investors. They take actions based on those?
So let me do a step back. So since investors increasingly care about corporate sustainability, we know also from other work that negative news about something that the company is doing regarding its environmental and social policies and the negative effect on valuation. Now, what we don't know is whether investors' reactions can actually determine a change in corporate policy. Okay, and the news here and the data are just instrumental to try to evaluate whether market discipline works. And this is something that we didn't know from previous research. From previous research, we know, and there is a lot of there is also a lot of news coverage that some institutional investors call up the manager, press the board to improve some aspects of environmental and social policies. But most of the institutional investors, or even individual investors, don't have those resources, don't have direct access to management. So can they affect what a corporation do in the way they trade by affecting the stock price. This is what we are the first to ask. Okay, and why are the news so important? Well, think of, we can look at corporate valuation and relate the corporate valuation to ownership structure and say, well, some type of investors care more about environmental and social policies, and perhaps they tend to hold the companies that have a better environmental and social policies. But that is might be just that they have chosen to buy those companies. Doesn't mean that they affected those corporate policies. Okay, so basically the idea of our research is saying, well, let's take a negative shock. Let's see if investors with certain preferences indeed show more discontent after these shocks. And then let's look at what the corporation does afterwards. Okay, yeah. And this is why the news are so important. But otherwise, it's just a way to have a shock that to say, well, some investors will be more unhappy, and does the company answer to that? And this is what we find in that paper. So we can say that money talks.
Money talks. So it's a sort of a dynamic system, isn't it? And so a negative shock occurs. Perhaps institutional investors are more tuned into it. Maybe they take actions. Maybe retail. Did you see any difference between institutional investors and retail investors? How they might react to news?
So that would be something that would be very interesting to explore, but unfortunately there are not as good data sets covering institutional investors' ownership and trade. So what we can talk about in the current research is only how different types of institutional investors react. And institutional investors have different preferences that partially reflect also the preferences of the retail investors that hold the shares in the fund. But unfortunately, that part is still silent. We can only speculate from the results of the current paper.
Yeah, so in the paper you find companies take actions based on the ENS risk metrics, really driven by investor reactions to it. ENS risk is not a qualitative risk, isn't it? I mean, it does have long-term profitability questions for the companies, I would think, right now.
Yeah. So in the mechanism that we have in mind that we test in the paper, the company actually does something that is also desirable from the point of view of long-term value. And the reason is the following. If a company is, for instance, headquartered in a country in which most of investors care about environmental and social policies, then if investors are discontent, we know that this company cost of capital would increase. So the company in the long term will be able to invest less, will have a lower valuation. Okay, so these are precisely the companies that answer more when there are these shocks, because they try with their policy to reduce their cost of capital for future investment.
Yeah. And I would imagine there is an effect on the consumer side too. You know, I don't know what the situation is in Europe, but we have sort of a cancel culture now in the US. You know, when people see something, they just basically stop buying the company's products, for instance. And so I think the effects are not only on the financing side, but also on the demand side for the company's products, I would think.
So this is an excellent question. So market discipline can work through the capital markets, and it can also work through the product market. So in that paper, we try to do something to understand how the product market is working in this respect. And we take into account that the international companies in our sample sell in different countries. And again, preferences for environmental and social policies are often related to country culture. So we see indeed that when these incidents occur, sales in countries that have stronger preferences for environmental and social policies decrease. However, the effect that we find on market discipline is weaker. Okay, so one reason could be that even if there is a drop in sale, this drop in sale is likely to be only temporary. And one reason is that these consumers or the firms that purchase from the firm have access to less information than institutional investors. If you think of it, the data sets that we use to observe these incidents, these are compiled mostly for institutional investors. The institutional investors are the main customers of the companies that collect the data. So customers and sales seem to react mostly to incidents that have broad international news coverage, and only in that case we observe that firms that sell more to customers that are environmentally and socially conscious have a larger drop in prices. But we don't see a long-term effect in policies. There might be some data noise, but we conjecture that this market discipline through product market might be a bit weaker. Not because consumers do not boycott, but perhaps because they tend to forget or they are less persistent in their policies. So.
Right. And I guess it also affects where customers are. If your customers are in countries that are more conscious of ENS policies, then it might have a bigger impact. But then for multinational companies, obviously, that should not really have that much of an effect. You have another paper recently, Adapting to Radical Change, the Benefits of Short Horizon Investors. You show that following shocks that change an industry's competitive environment, firms with more short-term institutional investors experience smaller drops in sales and investment and have better long-term performance than similar firms have been affected by the shocks. That is a bit counterintuitive because we would think in financial markets, short-term traders, so to speak, don't really affect outcomes. But these are not traders, but they are essentially sort of a short-term horizon investors, right? So they have a higher influence on corporate policies.
Yeah. So let me do a small step back. Your intuition was before we published this paper was somehow received wisdom in the academic literature and largely also in policy debates. Okay. So short-termism and short-term investors in particular are often accused of the fact that the firms do not invest enough or perhaps they don't have policies that are sustainable in the long run and so on. However, if you consider one of the problems in Japan, Europe, and more recently also in the United States, a concern is that there are many firms that are called zombie. What is a zombie firm? Well, these are firms that have low productivity, whose market share shrink slowly over time, and so on. They look like firms that in the long term won't be able to survive competition. Okay, And what we conjecture in that paper, and then we investigate empirically, is that, well, sometimes forcing management to do things fast may actually be desirable for firms to restructure and to adapt to a new environment. And in order to show that these may have some merit, we take as an example a situation in which competition increases. And this was related, for instance, to the increased imports to the United States from China. This is clearly a situation in which, well, some companies have to change their products. They cannot compete any longer with low value-added products that are produced in China for much lower cost, okay? And we ask, do some companies adapt faster than others? Okay. Short horizon investors are investors that have a bit different incentives, and the reason is the following. Okay, we know from a large literature that investors, for instance, in mutual funds, redeem if they see poor performance. Okay. So in order to avoid this, mutual funds and other short-term investors, if they think that a company may be underperforming and will have perhaps with some probability a price drop in the future, have stronger incentives than investors who are not subject to redemption to sell today. Okay, so basically companies with a lot of these short-term investors that have a higher risk of a fire sales of their stocks and a larger price drop, okay? So what we say is that if the management of this company has compensation that is tied to the stock price, these companies want to avoid the price drop no matter what. And they might have stronger incentives to adapt. So what we observe in the data is that when this increasing competition occur, companies that have relatively more short-term investors within an industry are more likely to turn over the management team, are more likely to come out with a new patent and trademarks, and this allows them to maintain a larger market share. So what we propose is that short horizon short-termism has a role in corporate governance that has been neglected, and that can help to avoid this sort of zombification of the economy.
So how do you differentiate here in terms of horizon? When you say short-term investors as opposed to long-term investors, what's the horizon you're talking about between the two?
So basically, an institutional investor's job is to invest and to generate returns for its investors, okay? And investors have different strategies, okay? Some investors invest in assets that are illiquid, and therefore generate good returns only if they are held for the long term, okay? Or think of assets that are currently undervalued, but might be thought to generate a long-term return. Other investors, instead, they trade more on the order flow, on very short-term information. So these are the short-term investors. In practice, when one tries to measure which investors are short-term, one looks at the portfolio turnover of the institutional investors in the past. An institutional investor that turn over a large part of its portfolio in a quarter is a typically defined short-term investor. So this is the proxy, but this reflects the liability structure of the investors, how much the investor is subject to redemption, the kind of contract that the fund manager has been given, and so on.
Right. And so, if I understand this correctly, a change in the competitive position of the company, for instance, will have a higher drop in valuation in the horizons that short-term investors are focused on. Whereas in some sense, the long-term investors have the luxury to wait. And so if I understand this correctly, what you're saying is that the short-term investors will be more active. They will take actions a lot faster. And that would force managers to take appropriate actions or to bring the firm back to some extent, right? Is that about it?
Yeah, yes, precisely. So the way in which I see my view of corporate governance is that different type of investors with different incentives can cure different problems in financial markets. Of course, investors that are more long-term can help to solve long-term mispricing problem because they can see profit opportunity and they are not concerned about prices moving against them in the short term.
Right.
So they, of course, have an important role in financial markets. But we don't have to remember that sometimes managers may have incentives to pursue the same strategy, perhaps because their skills are better adapted to that strategy, and changing the company business to some extent would imply also admitting not to be any longer the same match. And there are other type of investors that have that provide a more short-term pressure, that are more desirable to generate a long-term value for the company in those instances.
Yeah, so sort of the right mix between short-term and long-term investors might be beneficial for the company because they get different signals in some sense of this investor actions, right?
Precisely.
So I want to go into another recent paper you have, Public Attention to Gender Equality and Board Gender Diversity. You say we document an increase in female board representation following heightened public attention to gender equality. The improvement in board gender diversity is driven by firms whose ex-ante culture is already sympathetic to gender equality, most likely because of increased awareness by the top management rather than institutional investors' external pressure. Yeah, I mean, we are in 2021. It is still fascinating that we are talking about gender equality.
Well, we talk a lot about the gender equality or the racial equality, or we talk a lot about representation, right? So.
Yeah, it's. I saw an interview by a CEO of an airplane company recently, and he was saying he needs to. He finally realized he needs to pay higher attention to this problem. And I was thinking, if you're a CEO of a Fortune 500 company and you just realized you have to pay attention to this problem, perhaps that's not a good job. You know? And so you're finding here public is paying more attention to this issue, and it has some effect.
Yeah, so basically, we are all aware that attention to issues like gender or racial equalities changes over time because of news or coverage of specific events. And if we think of gender equality, for instance, of course, the Me Too movement, the Hillary Clinton campaign attracted a lot of attention to this issue. But also at the beginning of our sample period that is starting 2006, there was a lot of attention to gender equality issues because it was, if you remember, in 2009, President Obama enacted some laws about equal compensation, fair compensation of for women and minorities. So when there are these events, people read more news, pay more attention to news about equality. Okay, so to some extent, what we do there is very simple. We look at Google searches about gender equality, feminism, and so on. And basically, these Google searches have been shown in different contexts to really capture how much society is currently caring about an issue. And then we ask, do companies respond, and which companies respond more? Okay. In principle, one might think that, well, if society is changing, perhaps companies that are currently farther away from the society standard respond more. Okay. And what we find is that is the contrary. We have a different proxy for capturing the corporate culture towards gender equality. Some are based on ESG rating about the diversity. Others are based on textual analysis that capture how a company seem to respect the differences between employees. And then we also use the political orientation of the executive team. Typically, the Democratic platform has paid more attention to gender equality problems. Well, we use whether there are women in the management team as another proxy for corporate culture. So according to all these different proxies, what we see is that companies that we would classify as pro-gender equality in these periods in which there is more public attention seem to appoint more women to the board, while companies that had concern about their diversity policy from rating agencies or that have a more Republican executive team, they respond much less, if at all. Okay, so it looks like that there is no convergence. We also look at perhaps these companies face supply constraints. When women are in high demand, they can choose, and they go to companies that have a culture that is more inclusive. So when we look at the characteristics of the directors that are appointed, even in these periods of very presumably very high demand for female directors, we find that there are enough women, meaning that women seem to continue to have the same characteristics that had in periods of low demand, meaning that they say the women that are appointed when a lot of other women are appointed seem to have the same years of executive experience. They have the same propensity of high-level degrees, of having won business-related prizes, have a similar level of industry experience, and so on. So there is no obvious evidence of supply constraints. So what we conclude is that the corporate culture matters for how receptive companies are to societal change. And perhaps if one wants absolute convergence, quotas like in California might be necessary.
Yeah. Yeah, I find this very interesting. So if I understand this correctly, so what you're saying is that ex-ante culture matters. And so you say here, female director appointments generate higher abnormal announcement returns in periods of high public attention, especially in firms with an ex-ante culture less favorable to gender equality. So in some sense, if you have a non-inclusive culture, let's call it, you actually have a higher potential for abnormal returns. In other words, you can increase your shareholder returns by paying attention to it. An equal amount of attention in a firm that is less culturally favorable, an equal amount of attention will have a higher shareholder return for that company, right? Is that what you?
Yeah. Yeah, so basically, we look at the announcement return of the appointment of directors with different characteristics. And we find that in these firms that are less receptive of societal change, less receptive of gender equality, actually when they appoint a woman, they have higher returns. So than similar firms that are more equal. So this suggests that the women they appoint as directors are not going to harm the firm. They are going to be useful, and perhaps it's a signal to the market that the company might be changing, and that's a way to generate return. A bit consistent with the anecdotes that you were starting from. So.
Yeah, so it's really the difference to expectations. If market's expectations are low, by taking actions, the firm can substantially increase. It will be a positive shock in some sense to the market, right?
Yeah.
So we have another set of papers, recent papers on monetary policy here. So I want to get into that. From 2017, forced asset sales and the concentration of outstanding debt, evidence from the mortgage market. You say we provide evidence that lenders differ in their ex post incentives to internalize price default externalities associated with the liquidation of collateralized debt. And so when you have sort of non-performing debt on your books, you're saying lenders sort of behave differently. What is the primary finding here?
So a lot of times, and this was for sure the case during the real estate crisis, forcing liquidation may lead to a negative externality, what we often call a price default spiral. What is, in a more concrete point of view? So during the real estate crisis, there were lots of foreclosure. There is evidence that if a property is foreclosed, the value of the nearby properties decreases. Okay, and of course, these may give to the neighboring borrower stronger incentives to default. And we can think that there are also broader externalities on the neighborhood. The properties foreclosed, people move out, so also the stores that are nearby have less sales and so on. Okay. So, and during the real estate crisis in the US, there was a bit of this narrative that perhaps there are too many foreclosures. Okay. And so the question was, well, there are these negative externalities. Perhaps there are too many foreclosures. So, but why wouldn't some lenders take this into account? So, what we say in that paper is that, well, this depends on the incentives of the lender. So in some neighborhoods, and those are really tiny neighborhoods, basically we take the census tract that is smaller than a zip code, okay? In some of these neighborhoods, there is one lender that has kept in the balance sheet a larger fraction of the outstanding mortgages. Okay, if this is the case, this lender, when he decides whether to liquidate a mortgage that is foreclosing the house, or whether to renegotiate, so postpone the payment and so on, takes into account that, well, if I foreclose, perhaps I can get some cash soon, but this will have a negative effect on the value of the mortgages of the nearby properties that are on my balance sheet. So what we show both in a model and in our empirical analysis was that, these lenders actually are less likely to foreclose in comparison to other lenders in the same neighborhoods that have kept very few mortgages in that area on their balance sheet. And this matters because then we show that neighborhoods in which there is a high concentration of the outstanding mortgages, because there are very few lenders that kept these mortgages on their balance sheet, are more likely to take into account these externalities. They experience fewer foreclosures, and unsurprisingly, their house prices dropped less during the global financial, during the real estate crisis.
Yeah, that makes a lot of intuitive sense. So again, if I understand this correctly, if there is one lender, X, in a town Y, and that lender is the only lender in town Y, and the first house coming up to foreclosure, that lender has to consider the effect of that foreclosure on all of its other assets, or all of its other lending assets in that town. And hence it would essentially forego sort of the tactical benefit from foreclosing because the net loss from the town is a lot higher. And so I was wondering, so this may have some, well, it'd be difficult to impose a policy around this, but from a stabilization perspective, it appears that concentration of lending is actually a good thing, right?
So this is definitely true, meaning that we don't want to say that low competition is necessarily desirable. But when there are these financial crises, when there are bad assets, concentrating the bad assets might be the optimal policy in order to avoid excessive liquidation.
Yeah, it's obviously difficult to impose that in a free market system. But investors, this is good information for investors in the sense that if they're estimating what the net loss is going to be, if there is a higher concentration. So, for example, I was wondering, Mariassunta, from a local market perspective, and I am a real estate investor in a sort of a local market, I would be very interested in looking at sort of a concentration of lenders in that market. If there are a large number of lenders, then in a negative shock, it's going to sort of propagate through the system. Whereas if it's only one or two lenders, it has sort of a stabilization effect on that local market, right?
So so if you are to buy a house, definitely you would expect that less volatility in housing prices in areas with high credit concentration. On the other hand, if you are running a real estate company during the global financial crisis, a lot of institutional investors made lots of money out of the fire sales that were caused by very dispersed ownership of the mortgages, because there were areas in which all the mortgages were securitized, and that was basically no one was internalizing externalities, because the owners of the mortgages, they didn't even own one mortgage, they owned the pieces of the mortgages. And there, institutional investors that bought at fire sale prices, the foreclosed properties, for sure made a lot of money. So.
Right. Yeah, I want to go into sorry.
Yeah.
Go ahead.
So just to elaborate on this point, there are broader conclusions for investment, because in a subsequent paper that we published a couple of years later, we looked at the same mechanism for general industry shocks. So basically, there are fire sales, also companies' assets. And then basically we ask whether some banks internalize the negative effect of fire sales by providing liquidity. And what we show there is that in industries in which the provision of credit in the near past, say in the 5 years before the shock, was more concentrated, the industry returns following negative shocks are much higher. And the reason is that while these lenders are more likely to provide the liquidity, not only to borrowers in the industry in distress, but also to their customers and suppliers, because we know that these shocks propagate. So these industries with concentrated lending seem to get out faster from distress. And this is another investment insight that can come from the basic idea.
Yeah, it seems like there could be some sort of optimum concentration, because it has ambiguous effects. If there is concentration, that implies there's pricing power. So for an individual investor or individual buyer, when you get into the market, you're probably paying a higher price, sort of like an insurance in some sense. In a negative shock, you have stability.
Yes, so we look at at equity returns, and of course the price of equity today would presumably incorporate that with some probability there will be a shock, and these stocks in a particular industry will perform better. So from the point of view of the equity investors, however, this would imply that these shocks have most likely a lower beta, or they have lower downside risk. From the point of view of the credit provision, of course, a concentration can have a cost for the borrowers, meaning that the bank that is the large lenders has pricing powers, and therefore one will have to pay for this insurance. So there is obviously a trade-off, but what my research in the area has suggested is that a more concentration in an industry or in the provision of mortgages can enhance stability when shocks occur.
Yeah, that's really interesting. So I want to finish up with another paper, a recent paper. Is there a zero lower bound? The effects of negative policy rates on banks and firms. You say exploiting confidential data from the euro area, we show that sound banks pass negative rates onto their corporate depositors, and that pass through is not impaired when policy rates move into the negative territory. So the intuition was that when the interest rates hit zero, you don't really have much more flexibility to change anything. But if banks are really passing on negative rates, and I was talking to somebody in Switzerland a couple of months ago, and it is really true that you have negative interest rates. So you have to pay the bank to keep your money in the bank, so to speak, right?
Yeah.
And so if that's happening, it's less of an issue. You are saying there is no really zero lower bound.
So basically, let's start from the point where macroeconomists were up to 2014 when policy rates started to become negative. So all the macroeconomic models basically were implying that, well, the lowest rates can be is zero. And when they think about the transmission of negative policy rates, basically the assumption is, well, if the bank wants to charge on your deposit for you to keep the money there, well, you can just withdraw and move to cash. Therefore, there is no way for the banks to charge negative rates on deposits. And if banks are charged negative rates on their liquidity deposited at the central bank, this means just that bank profitability decreases, banks will be in worse shape. Lowering policy rate below the zero lower bound just cannot work for stabilization policy. But so this was theory because the negative rates never occurred.
Yeah.
Then the European central banks decided to go below the zero lower bound. And of course, there was opportunity to start to look at what actually happens. And basically, my zero lower bound paper tells, well, many things work exactly as above the zero lower bound. What we show is that when the European Central Bank started to communicate to the market, look, not only the policy rate is now negative, but will stay negative for a while, then banks started, at least some banks, started to charge negative rates on their larger depositors. And the larger depositors are typically corporations. Okay, so that's, and we document that the banks that charge negative rates on deposits are banks that have investment grade rating, very few non-performing loans. That is a healthy bank. Is this surprising? If you think of it, it's not, because the German treasury bills have negative rates, and keeping deposits in a healthy bank provides liquidity, the same convenience for the holder as holding safe treasuries. Okay, so basically we started documenting that this occurs, and then we explore a bit more the transmission mechanism. That works a bit differently, but we see an expansion, meaning that a firm that is charged a negative rate on its cash decides, well, perhaps it's no longer time to pile cash holdings for the bad times, and they start investing more. So we documented this positive effect of negative interest rate policies for the first time.
Yeah, so this is really a good thing, right? A negative interest rate would have the right behavior. Essentially, the firm investing more rather than holding cash, and that is what we are trying to accomplish through a monetary policy. So you're also saying that essentially a sound bank, a high-rated bank, their policies are going to be, they're going to proxy sort of treasury note behavior. If there is negative interest on the treasury side, then a AAA rated bank will have essentially the same. But you mentioned that it is only for the large depositors, so corporations. And obviously, I was wondering about the retail arena. There are different ways the banks could charge a negative interest rates. They don't necessarily have to charge an interest rate. They could just increase, costs for services, cost for cashing checks, they could do a lot of different things to essentially get to the same point, I would think, right?
Yeah, that's what they did. So on retail deposits, that most of them, are smaller, is we don't see negative rates. And, towards the end of our sample, we see that some banks started to charge some negative rates also on household deposits. But we see that all banks, independently of their health, have increased fees. And the reason is that the fees, are more opaque, and is on a small deposit, the fees can increase bank profits and the effective interest rate very efficiently. So there is no need to go negative. Right.
Excellent. So I want to ask you sort of, not in the paper, but a general question. COVID crisis, things appear to be settling down, but we have more variations coming through. It's unclear if vaccines that we have are really going to take care of it. So what's your general view as to the world economy and how the countries are dealing with, where are we in the cycle? Are we sort of plateauing at the bottom, or things are coming back up again?
Well, so I think that the way in which I think of the COVID crisis is that it generated a lot of uncertainty, and it really changed the demand for products. Now, if indeed the vaccine are effective and hopefully distribution reaches also developing countries, hopefully the economy will start booming again, and we will be out of it. I think that over the next few years, what I'm also very excited to look at research-wise is how international trade and supply chains, that is trade between different firms, will change. Because with COVID, climate risk, very tariffs and trade wars, what we saw is that companies have faced a lot of uncertainty about their customers and suppliers, and we still don't know much about how this has affected relationship between firms, whether these will give rise to merger waves as firms seek to acquire their suppliers in order to secure inputs and so on. But hopefully we are out of it. I guess the epidemiologists know more than financial economists, so I can at most share a hope that.
Yeah, I want to get your insight quickly. So it felt like you were saying, the relationships in the supply chain and other aspects, there could be long-term negative effects there. At least on the surface, it appeared that when you have a systemic shock to the world economy in a highly interconnected system, it appears suboptimum to really have country-by-country policies. Because we cannot really solve a pandemic by vaccinating a town or a city or even a country to some extent, unless you're New Zealand or something like that.
Yes.
Where you can shut down the borders. What is your view on that? How do you intervene in a worldwide systemic problem like a pandemic?
Well, I wish there had been more coordination, but even if I look at the European Union, I think that from the point of view of the vaccine and the vaccine rollout, there has been a lot of coordination, but policies in different countries differ dramatically, even in use of masks. Okay, but on the other hand, within the EU, people can travel reasonably freely. Perhaps you have to exhibit a COVID test or the vaccination certificate, but we know that this has limitation. And yeah, I hope that we'll get out of it soon. So that's, I think that this coordination has just not been there, and the limitations in the initial vaccine supply don't help, right? So
yeah, yeah.
you
Let's
see
hope
also
so.
rivalry with the UK and so on. So these are very difficult problems. So
Yeah, yeah. Excellent. Yeah, this has been great, Mariassunta. Thanks so much for spending time with me, and enjoy the rest of the vacation.
thanks a lot. Thank you for having me. So that's thank you. Bye.
Bye.